Hi, this is Mark Wahlstrom, and welcome to this week's edition of Speaking of Settlements, a featured broadcast here on the Legal Broadcast Network. Well, I'm here talking to you today about some very interesting news. As we all know, really since September, we've been just looking at tremendous turmoil in the financial markets, in the stock market, mortgage markets, and a lot of this turmoil has spilled over and caused a tremendous amount of anxiety and uncertainty about the safety and solvency of life insurance companies. Most of this concern really was related to what went on with AIG, American International Group. And as we've explained in many of our prior posts, both blog posts and in podcasts and broadcasts, is that the situation with AIG was really kind of unique. They had a particular division, financial products division, that was heavily betting on derivatives and these mortgage guarantees. It got out of control. It threatened the company. And as we now know, we have the AIG bailout, which, we'll get into some of that in subsequent broadcasts, has been modified, but began to raise some concerns in the eyes of the general public about the safety of life insurance companies in general. The entire financial sector, life insurance companies, property casualty companies, but I'm talking primarily about life insurance companies now, just got absolutely bludgeoned as far as their stock prices. Tremendous concerns from people about the safety of their annuities, the safety of their life insurance contracts. And as you go back over some of our old broadcasts and podcasts, you'll note that we really were preaching caution. I have always been of the opinion, again, I wasn't positive on the AIG deal, but as it became clear as time went on, just how strong and solvent the life companies were. But AIG is a special case, and what has happened is the insurance industry has been tarred with a lot of the same concerns, a lot of the fears, and those fears were accelerated at the end of the third quarter of '08, when many companies were required under accounting rules, under NAIC regulations, that's the National Association of Insurance Commissioners regulations, to begin to make some reserve and surplus calculations to their portfolios as a result of the drop in the stock market. And many of these were tied to variable annuity products. And some of the companies that were kind of dragged down with this undertow, Lincoln Financial, Hartford, Metropolitan Life, Prudential, some of the biggest names, really, John Hancock, Manulife, many of the biggest names in our industry were dragged down on these fears that, now the variable annuities are costing tons of money. And again, you saw this tremendous fear in the financial and the life insurance sector, to the point where many of the stocks were trading at levels where they were really below the book value of the life insurance company in question. We hit a point, and this is a very key period of transition that people needed to be aware of, is that these reserves, and we've talked about this in prior broadcasts, when companies are required by regulations or industry standards to put aside reserves, the only people who are hurt by that at that point really are stockholders. When money is put into reserve, that is a very, very good thing for policyholders, for annuitants, for life insureds, because that's putting money aside, making sure that their claims are going to be paid. Well, as a result of these reserve calculations, a lot of things that are going on, the American Council of Life Insurance, the National Association of Insurance Commissioners, and other industry groups have really been looking at the reserve requirements for many annuity and insurance products. And they've come up with a set of regulations and guidelines that they're going to vote on before December 31st of this year. And these changes were reported last week, and they're also reported this week in the Wall Street Journal. And these are very important changes. And because what's happened is the industry has been so conservative, has had such strict surplus and reserve rules, that many of the insurance companies and many of the insurance commissioners believe that the life insurance companies are essentially over-reserved. They have too much surplus, and they're being forced to put too much money aside to protect and pay against claims. Now, the example on this is that just last week, when Hartford and MetLife both came out and reported that even if the stock market dropped another 20 to 25%, they would have more than adequate surplus and reserves to maintain their A-plus ratings or A-plus, double A-plus ratings, depending upon the rating agency that they're using. This is very important because many of the concerns and many of the issues and many of the capital raising devices these companies have gone through, whether it's looking to accept money from the government or partnering with other life markets, has been used to maintain their double A plus, triple A rating, A plus ratings, because that's very important to their business plan. When Hartford and Met made that announcement last Friday, particularly Hartford, their stock went up 100%. And what's happened is people have begun to realize that this fear of collapse, this fear of insolvency was dramatically overblown, that these changes that were made, these funds that were put into reserve, are essentially, it's money in the bank and money that's being put aside to protect policyholders, protect annuitants, protect insureds. And the rules are so strict and the rules are so onerous that they essentially create huge surplus positions that penalize the company as far as their ability to continue to expand their business and do a variety of things. So the National Association of Insurance Commissioners is going to make some recommended changes there, and we'll get into the details of these when the time comes. But really what we're going to see voted on, and I would expect from everything that I'm reading, everything that I'm hearing, that this will come to pass, is that some of these reserve and some of these surplus requirements that have been put out there by the NAIC and some of the accounting principles that have been so conservative are going to be adjusted somewhat in order to not make these reserve requirements quite so draconian for the life markets. Now, I think this is a good thing. Because what you don't want to do is have the companies having them being compelled to put more money into reserve and surplus than is prudently needed to run their business. Just as you don't want them under-reserved, there's no purpose served by them being over-reserved either. And the ACLI and the NAIC estimate that with these rule changes in effect go into place for early 2009, that up to between $22 and $28 billion in reserves will be freed up, additional capital that can be redeployed by these life insurance companies without risk to their ratings, without risk to their policyholders. But I think it will go a long, long way to ease the credit crunch, to ease the cash flow requirements of these life companies. And again, this is a perfect example of self-regulation, essentially working where these companies don't need cash infusions. They've got plenty of cash. They're making sufficient money. If you look at MetLife's earnings, MetLife is looking at a very good quarter in fourth quarter of 2008, analysts are predicting, which given the turmoil, what's going on, people are beginning to realize the life companies are solvent. The life companies are well capitalized. They have huge surplus, huge reserves. The vast majority of these companies, and I think we can safely say all of the companies in the structured settlement industry who write structured settlement annuities are going to come out of this process not only intact, but I think in tremendous shape financially. And as I've predicted in some of our blog posts when we talk about the golden age of structured settlements, we're going to see a huge shift in perception about life insurance companies and annuities in general as people realize that through this huge market dislocation, through the crash of the real estate market, the crash of the mortgage market, the crash of the stock market, and what I'm predicting to be the coming crash in the bond market as interest rates accelerate, that guaranteed fixed rate products from well-capitalized, highly rated insurance companies are among the safest places for people to put their money. So we'll be doing a series of blog posts and commentary on this. We'll be getting the NAIC proposals up on our website. I encourage you to follow this if you're in the structured settlement business, if you're a financial or settlement planner, or if you're just somebody who's worried or concerned about the safety of their annuity contract. Obviously, we need to continue to be vigilant. We need to continue to monitor the health of respective companies. But I think these are all very good signs and an indication of the long-term health and stability of the life insurance market. Anyways, that's our broadcast for this week on Speaking of Settlements. We'll be coming back to you again next week with more news of interest to settlement and financial professionals and trial lawyers all over the United States. This is Mark Wahlstrom This is Speaking of Settlements. Thanks for joining us here on the Legal Broadcast Network.